The broadcast is now starting. All attendees are in listen-only mode.
Hi there, good afternoon. Thank you for joining us for the Average Income webinar today being presented by Patricia Murphy, Director of Compliance. Before we get started, we're going to go over a few housekeeping items. Please note this webinar is being recorded and will be posted to our YouTube channel for future listening. There will be a follow-up email sent 1 hour after this webinar that will provide that information in addition to a quick survey. Here are the housekeeping items. The control panel is automatically going to collapse during the course of the presentation. You'll see that on the right-hand side of your screen. You'll see an orange arrow, and to open that, you'll just select the orange arrow. When you open your control panel, you can select whether or not you want to call in to the dial-in number or use your computer's audio. Choose computer audio to use your computer's audio features. If you choose phone call, once you select the phone option, go to webinar will show you a phone number and access code. Use this information to call in. If you hang up and wish to call in again, you may need to wait a few minutes so that the system recognizes that you are no longer logged in and allows you to complete your call. If you hang up and call back in right away, you may get a busy signal or some other error. Also, if you called in for the webinar with a dial-in number but did not register online, you will not be able to participate. You must use the link to register if you wish to speak. If you're having issues with your computer microphone, you can choose the sound check button and the audio control to help you troubleshoot. We will be utilizing a rent test spreadsheet during the presentation. It is available in the handout section of the dashboard on the right-hand side of your screen. And if you have any questions during this presentation, please submit the question using the questions box and be sure to include your name and your question. There will also be an opportunity during the presentation for questions and answers. When it is your turn to speak, a moderator will call on you and unmute your mic, or Wendy Quackenbush will be answering your questions as well. Thank you for your participation. We will now move on into the Average Income webinar.
Hi, everybody. I'm Patricia Murphy. I'm the Director of the Compliance Division for the Texas Department of Housing and Community Affairs, and I want to welcome all of you to this webinar and thank you for joining us. We did do a webinar on the average income minimum set aside back in March of 2019, and that recording has been lost. So we're doing this webinar again, and it's time for us to do another one anyway, because we have a lot better understanding now than we did back then of how we're going to approach this. And we've refined some of our requirements and sort of updated things for how we're going to do this. As Renee mentioned, this webinar is being recorded and it will be available on the World Wide Web. So you will have the opportunity to ask questions, but if you don't want to be on the World Wide Web, you might want to save your questions and contact me or Wendy or Amy after, and we can answer your questions in private. We are only going to be answering questions related to the average income set aside. This participation in this webinar does require somewhat of a working knowledge of the program. We're going to jump right in and start using words like applicable fraction and eligible basis. So you do need kind of a basic understanding of the program. We offer training through the Texas Apartment Association about the full overview of the tax credit program and all of the compliance requirements. That information is available on TAA's website, which is taa.org. As Renee mentioned, we have that Excel workbook, and I apologize if you are not able to use it if you don't have Excel on your laptop or you're watching on a phone or something like that. And we're making it available as a tool that you could use and customize to help you manage and track average income. But we're not going to be able to offer you tech support on the use of that Excel tool today. And before we get in, I want to take a minute and thank Amy Hammond for working on this presentation with me. She did a really good job, and I was a real pain. Like I would say, well, on slide 17, I want an example about rent. And so she'd work really hard and put an example in, and then I'd go, no, I don't want that. But you just, anyway, so thank you so much, Amy, for working with me on these slides. You've done a fabulous job. So not too long ago, I was watching, it was like a conference or something, and the panelist was talking about the Compliance Division of the Texas Department of Housing and Community Affairs. And she said, well, when you're doing this, you need to know who the referee is and how they interpret the rules. And I thought that was a kind of cute little analogy, and it made me laugh a little. So today, we're going to talk about if you're playing the average income game in Texas, that TDHCA is the referee, and we're going to tell you how we interpret these rules, how we're going to evaluate if you're in compliance or not. So keep in mind that there's a lot of other states out there, and they probably will take a pretty different approach. So if you're operating in other states, this training might give you a good framework to approach other states and say, well, how are you going to handle this issue, to get an idea from them about how they're going to do it. But this is a very Texas-specific training. And this information is being provided absent formal guidance from the Internal Revenue Service and the Treasury Department on the average income minimum set aside. We know that they are planning on offering guidance, and we look forward to receiving that guidance. And we know you need to get started. You need to figure out, how do I do this? So we're moving ahead and providing this guidance to you. And I mean, it's not being provided blindly. We've been operating this program for a long time, and we have a lot of guidance from the IRS in their 8823 audit guide, and what they think should be reported, and what triggers an event of noncompliance that would trigger recapture, and what sorts of mistakes are not an issue that needs to be reported. So we're doing this training, and we've updated our compliance monitoring rules to incorporate a lot of the information in this training. However, if the IRS or Treasury Department releases contradictory or conflicting guidance, that immediately will supersede whatever we've talked about today or the information in the Texas Administrative Code. And we would, as soon as possible, update the Texas Administrative Code to align with the federal guidance. So the framework for what we're going to do is, first we're going to go over some basic stuff, so we all have the lay of the land and the right vocabulary and everything to talk about average income. So we're going to do basics, then we're going to talk about owner and manager responsibilities, then we're going to talk about TDHCA and our role in this. We're also going to cover transfers, the available unit rule, compliance with additional rent and occupancy restrictions if you have selected the average income minimum set aside. And then we're going to talk just a couple of random topics. So throughout the day, there'll be a chance to ask questions. But jumping right in, some of the key terms that we need to talk about is minimum set aside. And we're going to compare that to applicable fraction, which is the percentage of a building that is for low income people. And then we're going to talk about how to calculate your project average. This is like a nitpicky thing, but technically it's the average income minimum set aside or average income test. It's not income averaging, but that's sort of a word and a phrase a lot of people have started using. But throughout this, I'm going to say average income. So jumping right in, this is the language from the Consolidated Appropriations Act of 2018 that amended Section 42 of the Internal Revenue Code. And I know all of you can read, but I'm going to read it for you, and I'm going to emphasize some of the words. So that, and then we're going to look at, say, what does that mean? So in general, the project meets the minimum requirements of this subparagraph if 40% or more of the residential units in such project are both rent restricted and occupied by individuals whose income does not exceed the imputed income limitation designated by the taxpayer with respect to the respective unit. So there's the, in general, minimum requirements. Then we move on to average test. So the average of the imputed income limitations designated under subclause 1 shall not exceed 60% of area median gross income. And it's in 10% increments. So no one is going to say the Smith household I need to figure out what percentage of area median income they are. You're not going to say the Smith household's income is at 32% of area median income. If they were at 32% of area median income, you couldn't designate them as a 20, but you couldn't designate them as a 30 either. You could designate them as a 30, 40, 50, or 60, or 70 or 80. So we're not getting down to the actual percentage of area median income. We're getting down to these 10% increments. I think that all of you know the other two minimum set-asides are 20 at 50 or 40 at 60. So the 20 at 50 set-aside, there's only one income and rent limit. There's just one definition of what does it mean to be a low-income household and eligible for the tax credit program, and it's the 50% income and rent limits. For the 40-60 set-aside, likewise, there's just one income and rent limit. Even if you have additional rent and occupancy restrictions, for the IRS's purpose, there's just one income and rent limit, and it's 60%. For average income, this is pretty different. And federally, we have 20, 30, 40, 50, 60, 70, and 80% income and rent limits. And so the IRS did release a revenue ruling 2020-4 that explained how do you calculate, how does the State Housing Finance Agency determine and calculate and provide to owners what is the 20% limit, what's the 70% limit. So that information is out there. The average income minimum set aside, it certainly does expand who's considered a tax credit eligible household, who's low income. And I'm not suggesting that there's great federal alignment, but in a way, this is alignment between the nation's Affordable Housing Agency, which is the U.S. Department of Housing and Urban Development, and the IRS program. Now, both programs consider a household up to 80% to be low income. Obviously, it's only average income properties that can have an 80% household be considered low income and eligible for this program. But so it expands who counts as low income, and it's kind of consistent with some of HUD's programs. So for the 2050 set aside, 20% of the units in the project have to be occupied by households with an income and a rent under 50. For the 40-60, it's 40% of the units in the project have to be below 60%. And for average income, it's 40% of the units in the project have to be income and rent restricted. In May of 2018, the Internal Revenue Service revised Form 8609. So this is the form that the State Housing Finance Agency fills out Part 1. Each building in the Housing Tax Credit Program gets an 8609. That's just the IRS form number. And we fill out the top part and say how much credit the building has been allocated and when the building was placed in service, etc. And the bottom part is what the owner fills out. So in May of 2018, they just made one tiny change to the form, and all they did was they amended line 10C, and they added average income as an option that owners could pick. They did update the instructions. This was an opportunity to provide some guidance, and they didn't really provide much guidance at all. You can see the instructions for the average income test very closely follow the language from the Consolidated Appropriations Act of 2018. So now we're going to look at two different scenarios and consider the language from the Consolidated Appropriations Act to see what do we think it means. So here we have a building that is a project, and it has 10 units, and the owner intends for this building to be 100% low income. So all of the units are designated as tax credit units. They've selected average income, and they designated people at 30%, at 50%, 60%, and 80%, and we go out to monitor. And we look and we say, actually, 6 of these units are not in compliance. I don't know what's wrong with them. Maybe they're leased to student households that aren't eligible, but whatever the problem is, 6 of them don't qualify. So they have 40% that do qualify. However, it's 3 80% households and 1 60% household. So remember that in general, you meet the minimum requirements. So does this project meet the minimum set aside because 40% of the residential units in the project are both rent restricted and occupied by individuals whose income does not exceed the imputed income limitation designated by the taxpayer with respect to the respective unit? Does this meet the minimum set aside test? So today's September 2nd, 2020, and we don't really know. Let's look at another example. In this example, same situation, owner intends to be 100% low income. We come out, we say 6 of these units have a problem. 4 of them are in compliance though, and those 4 households, they average to less than 60%. So this project right here on this slide, we believe this, we know this project meets the minimum set aside for the average income test. The project on the previous slide, I think that the reading of the actual tax code gets me to, I think it does, but then the instructions on the 8609 make it seem more like you don't meet the minimum set aside unless you're this slide. And I have been working here for 25 years, and we have like 2,000 properties in our portfolio. And in this whole time and over all of those properties, I can only think of 2 housing tax credit properties that did not meet the minimum set aside. So it's something that we don't know, and I'm not convinced that we'll ever run into a situation where we have to know the answer to this question, because our property owners and our properties are generally in compliance. It would be very, very unusual for us to go to a property and see you were shooting for 100% and 60% of the units had some kind of a problem. Even if it was like a utility allowance problem, like a systemic thing, it would just, I don't think we're really ever going to have to know the answer to this question. And if we do, if we run into this situation, then we'll just call George at the IRS and say, time's up. You say you're going to give us guidance, and we need it right now. What's the answer to this question? So, but like I said, I don't think that we'll ever run into that. So for all of the minimum set-asides, 20/50, 40/60, or average income, these rules are the same and consistent. You have to meet the minimum set-aside to claim any of the credit at all. It's met on a project basis, meaning how you answer question 8B on your 8609. The default is that every building on a housing tax credit property is its own project, unless the owner properly elects to group 1 or more buildings together into a multiple building project. So let's say you have 10 buildings on your project. So the default is you have 10 projects. And so the minimum would have to be met in each of those projects. You can do that, or you can group all the buildings together. You can mark yes on line 8B and do an attachment and say all 10 of my buildings are one big project, and then you'd meet the minimum set aside over all of the units. Or you could say buildings 1, 2, and 3 are a project and all the other ones are their own projects. You can do any combination of things. But so it's based on you meet the minimum set aside looking at a project basis. And it's a unit count only. We'll talk about square footage when we look at the applicable fraction and how to calculate that. But for the purposes of the minimum set aside, it's a unit count only. You have to meet the minimum set aside by the end of the first year of the credit period, or you can't claim any credit ever, you're dead. If you don't meet the minimum set aside by the end of the first year of the credit period, you're not a tax credit property, period. And then it's checked on December 31st every year thereafter. Next, we're going to look at applicable fraction. And so this is a building rule. So we look to see how many low-income units are there in each of the buildings. And it's calculated as the lesser of the unit fraction or the square footage fraction. And to determine how much credit you're allocated and how much credit you're entitled to claim, we look at your applicable fraction. So real quick, basic, high level math for the housing tax credit program. It's the same for all the minimum set-asides. You take your eligible basis, which is in general the cost of construction, times your applicable fraction to get your qualified basis. Your qualified basis times your credit percentage of 4 or 9% gives you your annual credit. And your annual credit over 10 years gives you the total credit that you're allocated. So remember we looked at those projects where 60% of the units were out of compliance? Well, in those projects, if 7 of the units were out of compliance and they only had 3 units that were in compliance, to do their math, you would take eligible basis times 0 because they don't meet the minimum set aside. You have to meet the minimum set aside to claim any of the credit at all. So in those scenarios, when they're allocated credit, they took their eligible basis times an applicable fraction of 100% to get the qualified basis and then go through the rest of the formula. So those properties, those projects that we looked at on the prior slides, they have a big compliance problem because 60% of their units are out of compliance. But since the minimum is met, you would take eligible basis times 40% and run through the rest of the math. But if you don't meet the minimum set aside, you can't claim any credit at all. So we're going to look at this one building project. And this is 6 units in this project. Not all the units are the same size. Some of them are 600 feet and some of them are 850 square feet. And they're not all intended to be low-income units. This project has market rate units in it. So we're going to look at this one and compare the minimum set aside, the applicable fraction, and we're going to calculate its project average. So the project's minimum set aside, they elected average income. And for the rest of this training, remember there's the 2, does this meet it, does that meet it? We're going to, for the rest of the training, say the minimum set aside is met if 40% or more of the units average to 60% or less. So we take 6 units in this project, we multiply by 40%, it comes to 2.4. There's no 0.4 of a unit. So this project must have at least 3 units that average to 60% or less. And we meet it because we've got that 30% unit and that 40% unit in there. So we're going to average out to under 60 for at least 3 units. To calculate the average income for this project, you disregard the market rate household. You don't make any attempt to say the income of that household is 0% or 100% or something like that. So you're going to take the income designations of the different households and add them together and divide by the number of low-income units, the number of tax credit units. So we come out to the average income of this project is 60%. Next, we're going to look at the applicable fraction. So the applicable fraction of the building, you do take into consideration the market rate unit. And it's the lesser of the square footage fraction or the unit fraction. So for this building, there's 6 units and 5 of them are low income. So that comes to 83%. And if you do the square footage, there's 3,750 low income square feet and the total building square footage is 4,350. So if you're looking at the square footage fraction, the applicable fraction would be 86%. So we always use the lower of the 2. This is the same for all the minimum set-asides. So the applicable fraction for this building is 83.33%. So back on that slide that had the eligible basis, applicable fraction, all that. So for this building, we would punch in 83.33%, not the 86%. Note that the Consolidated Appropriations Act of 2018 amended Section 42G of the Internal Revenue Code. It did not amend Section 142. That's where the bond program lies. The tax-exempt bond program is in Section 142 of the Internal Revenue Code. And the Act in 2018 did not amend 142. So under the tax-exempt bond program, there's still just the two set-asides left, the minimum set-asides. There's 2850 and there's 4860. There's some legislation floating around that would extend the ability to elect average income for tax-exempt bond deals, but it's not passed yet. I don't know if it's going to, and if it does, it'll be prospective or retroactive, and we just don't know. But so for now, tax-exempt bond properties, you have to meet 2850 or 4860. And in preparing for this training, I was kind of interested to realize that most of the developments in the department's inventory that have elected average income are layered with tax-exempt bonds. That's most of what we see. So there are 4% credits. So they have an allocation of tax-exempt bonds and a 4% allocation of housing tax credits. So with that in mind, let's look at that project again that we just looked at and say, what if this was a tax-exempt bond property? So we already know the average income is 60%. We did that. And does the project meet the housing tax credit minimum set aside? And we said, yeah, they have 3 units that average out to 60% or less. But now what about the bond program? Take a look at those 6 units. Does this project meet the bond minimum set aside? Do they have 40% of their units leased to households with an income under 60%? And the answer is no, they don't. Even though they're fully in compliance with the housing tax credit program, they only have 2 units that are leased to households below 60%. So caution here, when you're layering these two things together, don't forget, you can do average income, but if you got tax-exempt bonds, you must have 40% of your units leased to households with an income below 60, unless you pick the 2050 set aside and then it's 20% below 50. Anyway, so what we're going to have to do to comply, to get this building in compliance, is the previous building, I think it had 3 80% households, and we can't have that many 80% households, and we're going to have to replace it with a 60. So when we look at, to get the project into compliance with both the housing tax credit and the tax exempt bond program, we need to lease a unit to a 30% household. And so now we recalculate the project's average, and it comes to 58%, which is fine. You just have to be below 60% and you're okay. So does the project meet the minimum set aside for the housing tax credit program? Yep, it does, because it has 3 units that average to 60% or less. And now, does this project meet the requirements of the tax exempt bond program? And the answer is yes, it does, because now they have 3 units that are below 60%. So be mindful when you're layering that you've got to meet both programs' requirements. In preparing for this training, we sort of looked at, if you look at the department's inventory and consider what's the average income, there's sort of 3 types of properties. There's hard no's, there's definite yeses, and then there's the murky in the middle. The hard no's are if you have already filed your 8609 and marked 2850 or 4860. So let's say you're a 2014 allocation and you started claiming credit in 2016. This wasn't an option in 2016. So when you filled out your 8609, you marked 4060. And you got a lot of foot traffic coming in that doesn't qualify. They're above 60%, but they're below 80%. You think, man, I wish I could do average income because I'm turning all these people away that I could lease these units to. And the answer is no. It's an irrevocable election that you made with the IRS, and you can't switch over to average income if you've already filed your 8609s. Then on the other end, we have the 2019 qualified allocation plan was the first time that average income was an option, and we've had properties that applied for, were underwritten, and awarded as average income. So those are clear yeses. We have a group of property that they're definitely doing average income. Then in the middle, we need to talk about developments that applied prior to 2019 and they have not yet filed their 8609s. So those developments, we're having some properties approach us and they're interested in an amendment. And it's one thing to amend your application And it's actually a different thing to amend your LURA. So let's look at the next slide. So again, today's September the 2nd of 2020. And if you already have a land use restriction agreement filed that requires the 4060 set aside, and you haven't yet filed your 8609s and you want to switch to average income, can you amend your LURA? And today the answer is, I don't know. Maybe you can, maybe you can't. And it's beyond the scope of this webinar to get into the yes, the no's, and the whys. There's third-party rights and a material amendment process you need to go through, and we're not able to answer that question for you today. So what we do need you to know is that if you are in this situation, we need you to understand that we are going to monitor you for compliance with the requirements of your recorded land use restriction agreement. So if you applied it as a 40/60 deal, you were underwritten as a 40/60 deal, your LURA requires 40/60. Even if you want to file your 8609s, electing average income, right now you are a 40/60 deal. There's nothing else for us to go by. You're a 40/60 deal. So we don't want you to be surprised that if you're leasing to households above 80%, above 60%, excuse me, or if you're charging rents above 60%, we will be filing 8823s with the IRS. We recognize that we can get into a situation where you have filed 8609s electing average income and have a land use restriction agreement that requires the 40/60 set aside. And that might be because although you requested an amendment, it's denied. Just because you request an amendment doesn't necessarily mean it's going to be approved. We also recognize, I hope we don't run into, but we recognize the possibility that you don't request an amendment and that you just file your 8609s electing average income and your LURA requires 40/60. So if that's the case, it's kind of like we need to monitor you twice. So we're going to monitor for the requirements of that land use restriction agreement because that's what's recorded against the property. That's the requirements. And if you have households above 60%, or if you're charging rents above 60%, it might not be reported to the IRS as federal noncompliance, but it is going to be sent to our enforcement committee and possibly be subject to administrative penalties. So if your 8609s are average income and your LURA is 40/60, we'll only report to the IRS if you're out of compliance with the average income set aside, the stuff that we're going to talk about in this training today. But we hope that we don't have a lot of this, but just we wanted to talk about the possibility of this. The next question that we get is, can I elect average income on my 8609s but still operate my property as 40/60 deal or 100% at 60? And the answer is yeah. We don't actually see any reason why you couldn't do that. If you're shooting for everybody's income and rent is less than 60% and you make a mistake, like maybe you miscalculate someone's overtime, just so long as they're under 80%, you're not going to have federal noncompliance. So I think that there might be some people interested in doing this, and we don't see any reason that you can't. And unless, I don't know why the IRS or Treasury Department would come out and say this is not permissible. So, I mean, I guess you could. Again, it's sort of like a double monitoring force almost that we need to check to see, are you out of compliance with federal requirements? And there's also, if you designate someone at 60%, their rent has got to be below 60%. So we might not report to the IRS that you're charging rent over 60, but by our state rules, you'd have to drop that person's rent to below 60. One other thing that we want to make sure is sort of a basic concept is that you don't have to offer all of the set-asides. So if you're doing average income, you don't have to do 20, 30, 40, 50, 60, 70, 80. You can pick just a few of the designations. However, the designations that you're offering, they have to be offered for all of your unit types. So if you have 1, 2, and 3 bedrooms and you're doing 40, 60, and 80% units, some of your 3-bedroom units have to be available at 40%, 60%, and 80%. Some of your 1-bedroom units have to be available at 40%, 60%, and 80%. And we're not highly prescriptive about this in the Texas Administrative Code, and I hope that everybody is reasonable and that we don't need to be. The other thing is that we're going to talk about is you have to have a waiting list for all of your units. And so in some ways, I wonder if complying with the waiting list requirements will just naturally get, because people are going to want a 3-bedroom, 40% unit, right? And so once their name comes up, it's their turn for that unit. So I'm thinking maybe some of that can work itself out with your waiting lists. Okay, Wendy, I think this is a good time to see, are there any questions in the question box that we should address now that we're not going to talk about later in training?
No, we're good.
Okay. We're moving into owner and management companies' responsibilities. And your roles and responsibilities with an average income property are actually quite different than they are with a lot of our other programs and land use restriction agreements. There's a lot more flexibility. There's a lot more decision points where you could do things. There's a lot more ways to correct noncompliance if you find yourself in non-compliance, and a lot of it is not going to be prescribed by us. We're going to say you're out of compliance, figure this out. How do you get that project average back below 60? So we're going to look at some of those things today. So we're going to talk about each of these in more detail, but it's your responsibility to decide what designations you're providing. We told you you don't have to offer all of them, but it's up to you to decide which ones are you doing. It's up to you to properly designate the households. You're also responsible for ensuring the project average comes under 60. You can do any combination of those. You're responsible for making sure that you know which projects are by your 8609 elections, and that within each project, you're averaging out to 60% or less. I've already mentioned you must maintain a waiting list for each of the designations, and it can't be a secret. You have to have it in your tenant selection criteria. You need to let current tenants and prospective applicants know that you have units available at those lower rents, and that if they qualify, they can get on a waiting list to get one of those lower rent units. In addition, you have got to decide, do I want to change people's designations as their income changes? You don't have to, but if you want to, and we'll talk about maybe why would you want to do that, you need to come up with written policies and procedures for how you're going to handle that. So looking at what designations are going to be provided. If you are tasked with leasing up one of these average income deals, instead of reinventing the wheel, the best place to start and what we're going to recommend you start with is the underwriting report. So this is a sample of what an underwriting report looks like. And on this underwriting report, they have 1, 2, and 3 bedrooms, and they've decided to do 9 units at 30%, 58 units at 50%, and 17 units at 80%. So if you are the leasing up, if you're responsible for leasing up this property, that's what you should go for, and maybe that will work. And if it doesn't work, it's not set in stone that you always have to have 30s, 50s, and 80s. That can change over time. You're responsible for making sure it always averages out to less than 60. So we're going to take a break from the presentation to look at the department's website so you can find your underwriting report. So real quickly, so if you go to support and services from the department's website and then go to real estate analysis, the front page of the real estate analysis shows 3 groupings of underwriting reports. The first grouping is always the underwriting reports for the upcoming board meeting. The second grouping is the underwriting reports for the most recent competitive awards of housing tax credit. And the third one is the historical underwriting reports. So we're going to take a look at that. And not every single underwriting report the department has ever issued is on here, but there are lots and lots and lots of them. So you could sort by city to try to find yours, but the easiest way is to do a Control F, and we're going to look at 20404. I remember that this is an average income deal, and we're going to look at them as a sample. And Amy, maybe you can blow that up a little bit. All right, so this property, they really decided they want to do a lot of set-asides. So they're doing 9 units at 30, 10 units at 40, 18 units at 50. So I say 70 units at 60, 20 units at 70, and 9 units at 80%. So they're really going to have a big mix of units there. Most of the other ones I've seen are just 3 set-asides. This is a lot of unit mix. That's a lot of waiting lists to keep up with. So this is how they were awarded. Their land use restriction agreement is not going to say you've got to have 9 units at 30%. It's going to say you have to have a project average of less than 60%. One thing I wanted to note about this underwriting report as well is this is a 4% housing tax credit property. So it's got the tax exempt bonds where they need to meet the minimum set aside for the bond program, and it's doing average income. So it's got 200 units, and to meet the minimum set aside for the bond program, 40% or 80 of those units have to be below 60%. And they're planning on having a lot more than 80 units under 60%, right? They're going to have, I can't do that math right now, but they have a bunch of 60s, 50s, 40s, and 30s. It's much more. So we showed that example just to make sure people kept in mind you got to meet both set-asides, but I don't really think that. I think most of our tax exempt bond properties are going to have way more than 40% of the units leased to households below 60. All right, so we're going to go back into the presentation, go back into your roles. And the next thing that you're responsible for doing is properly designating the households. We've updated the income certification form so that now you have the option of designating households in those 10% increments between 20 and 80%. And no matter which minimum set aside you have, you should only use the boxes for designations your property is offering. So if your property is offering 30s, 50s, and 80s, you should never mark the 20% box. Don't mark the 20% box. Just use the boxes that your property has decided to offer. That language from the Consolidated Appropriations Act of 2018 talked about the owner designating. And we looked at the 8609 already that the IRS updated, and that's not where you designate, right? They didn't say do an attachment and tell us which designations you're offering. So we've updated the income certification form so that we have a form, a process, and a procedure for owners to designate. So here's where you're saying that the owner, if the owner's elected the average income minimum set aside under 42G, this unit is designated by the taxpayer as, and this is where you're doing that function in the Internal Revenue Code of designating your household. And be mindful that when we monitor, we'll hold you to the rent that you designate that household unless you have policies, procedures for changing designations from the time they move in. So if you designate this person as 20%, then they get the 20% rent limit. So be very careful and properly designate your households. One thing that we are aware of is that many TDHCA properties also participate in other local affordable housing programs. So for example, if you have local home funds or, I don't know, CBG or some other program that we are not administering, and if you have a 20% set aside under that other program, this is a TDHCA form. Don't mark them as 20% because we'll hold you to that. So be careful about that. I want to point out that behind this pullout from the income certification form is the unit status report. As you're going to see today, we rely heavily on the unit status report in our monitoring. And it is critical that when you submit that unit status report to us before monitoring, that the information you're reporting to us is correct. So the units about, not the units, the columns about tenant paid rent, utility allowance, and housing assistance payment. That information should be current as of the date of the report. The rest of the information about the household name and their annual income and household members and is it a recert, all of that, that information should match the most recent income certification form in your file. So for example, let's say a household moved in January 2020, and they were paying $500 a month in rent, and you're filling out the unit status report today, and you changed their rent to $525 in June. So even though back when they moved in, the rent was $500, you're telling us now, as of today, the rent is $525. So be mindful about that. The next responsibility that you have is to maintain a waiting list for each of the designations that you're offering. And so I mentioned that you have to tell people what designations you're offering and how they can get on the waiting list for one of those lower rent units. The next thing you're responsible for is it's absolutely your job to ensure that the project averages out to 60% or less. Some of our land use restriction agreements are highly prescriptive. Like some of our multifamily direct loan LURAs, they're so specific. Like they'll say if you have 1-bedroom units and some of them are 500 square feet and some of them are 700 square feet, then this many of the 500 square foot ones have to be under the program and that many of the 700 square foot ones have to be under the program. Very, very, very detailed, where we say, here's this land use restriction agreement, do this, do exactly this. This is really different in that we're saying, hey, just make sure you come out to under 60. So it's absolutely your responsibility to make sure that you are coming out to 60% or less. The next thing that you need to decide is if you want to change designations as income changes. This slide right here is sort of a summary of part of the Texas Administrative Code in 10.611. And there are certain times that you have to change the household's designation. For example, if they become an ineligible full-time student household, you can't call them a low-income unit anymore. They're not low-income people. And you can always lower a household's designation, assuming that they qualify for the lower designation. What you might want to think about is, I know that our properties have really, really long waiting lists for their 30% units. So if you're offering 30% units and a household, you know that when they moved in, they were at 30% of area median income, but you're aware that now they're making $80,000 a year. Assuming that's not over income, which we're going to talk about later, but assuming that, you know, they're not over income, you don't have to change their designation, but you could develop and adopt a written policy and procedure about changing designations so that that household, their designation and their rent would be increased to something that's still affordable to them. And simultaneously, you'd be giving the benefit of that 30% unit to another household that's really at 30% of area median income right now and needs that designation and that lower rent. We did a webinar about changes to the compliance monitoring rules, and it's available on our website and on our YouTube channel. And we did a pretty long and lengthy discussion with a lot of examples about changing designations. And so rather than go through all of that again today, I'm just going to point you to that webinar, and the discussion about that starts at 29 minutes and 28 seconds into that presentation. Okay, Wendy, any questions?
We're great right now. Thank you.
All right. So we have talked about the owner's roles and responsibilities. So your job is to designate the households and to come up with an average that's under 60% with those designations that you're choosing. Our role is very different. We see our role very differently. And we are monitoring you. You're managing and operating property, and we're monitoring you to see, is there anything going on your property that we need to tell the IRS about because you're not entitled to be claiming the credit that was allocated to you? So that's pretty different than what you're doing. So until and unless we receive conflicting guidance from the IRS, we are going to monitor and examine the actual gross income and rent of the households and see which designation they could fall into to determine, is this project's average less than 60? So you're responsible for setting it up so that the designations come under 60. But when we monitor, we're going to look to see, irregardless, and I said that just to annoy Carolyn, irregardless of how you designated the households, do your people, are the people living on your property, are they really coming out to less than 60%? So a couple little fun facts. A while ago, I was working on a project, and I pulled like a massive unit status report of all of the people that live on housing tax credit properties. And not even adjusting for household size, the average income of the people living on housing tax credit properties is $22,477 a year. So our properties are serving very, 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 very low income households. And also about 40% of the housing tax credit units are occupied with households that receive rental assistance. So we know their incomes are very low, and we know that tenant portion of rent plus the utility allowance is going to make the gross rent be really pretty low. So we're going to look at that Excel worksheet now, and we're going to show you what we are going to do when we monitor. So this is back to who's the referee and how do they interpret the rules, right? This is what we're going to do. All right, so here you have this Excel workbook. It's got 4 different tabs. It's got the USR, the limits, the summary, and HTC testing. So before we can monitor you, you complete and submit a unit status report. And I went over how important it is that you give us correct information. This is actual tenant data, and we removed the name and building ID and stuff like that. But this is a real property. And so we downloaded its unit status report. On the limits page, we plugged in the income and the rent limits for this area. So we plugged in all of the 20 through 80% income and the 20 through 80% rent limits. And we've plugged in there the utility allowances. They have 1, 2, and 3 bedrooms. We're going to skip over summary, and we're going to look at HTC testing. So before we come out on site, this is what we do. So we look at this, and we look at each household and what you're telling us their annual income is. And we're figuring out, well, what could they be? So we highlighted one of the rows here. Look at unit 110, and the owner has designated these people as a 60% household. But when we look more closely, we see their income is $8,300 a year, and their tenant paid rent is $207 a month. So even though the owner is calling this a 60, we are recognizing, well, those people, they could be a 20. Note that this property is not even offering 20% set aside. So this property, if you look at column G, this property has decided that they're offering 30s, 60s, and 80s. So those are the set asides they have selected. So those people in unit 110, their 30% set aside was already met, right? And so when they leased that unit, they didn't need any more 30% households. Don't designate more than you need, right? So they said, well, I'm going to designate this one as a 60, and that's fine. They're doing their part right. They've selected 30s, 60s, 80s. They're designating their households correctly. But when we do our part, when our role, we look at this and say, well, just give me a 20. So go down to the bottom there, Amy, at the end of column G, and you can see there that the way the owner has set this project up, it averages to 54%. So they've given themselves a big buffer. They can go all the way up to 60%, but they're averaging out to 54. And it may be that it's hard to get those 80% rents, or they don't have that many people coming through the door that are above 60%. So for whatever reason, their project average comes to 54%. Now, if you go to summary, what we do is we look at, remember that household that the owner had at 60%, but we showed could be a 20%. So we see this project average is actually 50%, 50.5% is this project's average. So before, one more thing. I want to go back over to housing tax credit testing. Okay, and Amy, go all the way up to the top, and let's pretend that the rent for unit 101 is $1,200, and let's show them what happens if that's what they report to us. Oh, not annual income, let's do rent. There you go. So let's say they report to us they're charging $1,200, and note in red it says over 80%. Right? So when we download your unit status report, it does this testing for us to let us know if there are any units that are over the 80% income and rent limits. So before we've even opened a file, because they didn't report that, can you just do undo and go back to whatever? It was like $207 or something like that. Okay. So before we even open a file, we can see this property is telling us, I don't have anyone who has an income over 80%. I don't have anyone who I'm charging rent over 80%. And my project average is actually at 50%. So our full expectation is that this is going to be a no findings monitoring review. So let's see, let's take unit 101 again, and let's try and change their income to, let's change it to 38,000 and see what happens. I hope that's not over 80%. Okay, it's not. Okay, so let's say we pull the file for unit 101 and you had it as whatever it used to be, and we look at it like, actually, no. These people, their income, you missed a second job or whatever, and their income's actually 38%. So they don't fall into the 60% category anymore. They fall into 70. Go back into summary and show them how little that changes the average. It was 50.5%. That little mistake that you made, in that household, it doesn't have a big impact. It just changes the project average to 50.6%. So when we're doing our monitoring, we're going to see, you might make some mistakes, but does it make a difference? Because does it make the project's average go over 60%? So when we start out monitoring, we're starting out looking at what's the actual average. Amy, is there anything else I'm forgetting to say about the unit status report? Wait, I know one more thing I want to say. So, okay, in columns A, D, and AE, note that it figures out what could the household be classified at based on their income, and what could they be classified at based on their rent. And the final passing is the higher of the two. So see that third unit down? Their income is at 20 and their rent is at 30. And so since their rent is at 30%, we can't call them a 20%. So they count as a 30%. And when we look at if you end up in a situation where you do have some non-compliance and different ways that you could correct it, what you're going to be looking for is households whose rent is above their income, so that if you drop their rent, they'll fall into the lower tier and bring your average down. And so we'll look at some examples of that. Okay, so now we're going to go back into the presentation. All right, so we've looked at your unit status report, and you don't have anyone over 80, no rents over 80, your project average is of 50%, so what could possibly go wrong? So let's look at some possible scenarios of what could happen here. So when we pull your file, we're going to ask ourselves, is this household's income and rent below what the owner designated them as? And the answer is, if the answer is yes, great. I mean, even if you make a little math mistake, as long as they're less than what you designated them, it doesn't matter. If the answer is no, you called this a 60% household and they're not at 60% of area median income, the next question we need to ask ourselves is the household's income and rent under 80%? And if the answer is no, the income or the rent is over 80%, then you have a compliance problem. That unit is not in compliance. We've talked about the highest you can go up to is 80% and still call it a tax credit unit. But if the household income and rent it's above what you designated them, but it's under 80%, then we need to look at, well, what should this household, what could this household be designated at? And if we change the designation to what they could be designated as, the next question is the project average 60% or less? And if the answer is yes, that's fine. And if the answer is no, now with this correct designation, the project's average goes over 60%, that's where we think you have a problem. So note the two red boxes on your slide are incomes and rents are over 80%, or project average is above 60%. So let's look at some examples. So here we have a project that it's on that line 8B. Are you electing to treat this building as part of a multiple building project? And the answer is no. So this is a project that we're looking at. And this project's target applicable fraction is 100% low income. And they have 30s, 50s, 60s, and 80% units. And they think their project average is 55%. They meet the minimum set aside because at least 40% of the units average to 60% or less. But we pull the file for unit number 3, and we look at it and we say, you know what, actually, that person's income is not $53,500. You made a math mistake. You missed a second job. You forgot to include child support, whatever the problem is. That household's income is really $56,740. So this is definitely a time that we would notify the IRS that this project is not in compliance. And we would report this as household income above the limit upon initial occupancy. So the applicable fraction for this building is 75%. So remember the slide with the eligible basis, applicable fraction, qualified basis. So for this building, your applicable fraction is only 75%. You get to claim some of the credit because the minimum set aside is met, but you don't get to claim all the credit that was allocated to you because your applicable fraction is less than what it was when you were allocated credit. Let's look at another example. So here we have another one where it's a one building project. And this project, they've got 30s, 40s, 60s, 70s, and 80s. They do have a market rate unit in there, and their applicable fraction is 83.33%. They're meeting the minimum set aside because they've got 40% of their units averaging out to below 60. We start pulling some files, and we pull the file for unit 26. And unit 26, they were designated as a 40% household, but again, there was some sort of a math mistake or error. And we say, no, it's not a 40, that's a 50. So when we plug 50% into the average income calculation, we get that the project's average is 58%. We don't think there's anything to tell the IRS about here. There, you made a math mistake, that's okay. You know, they're a 50% household, not a 40% household. These are some very low income people making $33,000 a year. We don't see any reason that you're not entitled to claim the full amount of credit that was allocated to you on this building. Remember, you're playing the average income game in Texas, and I don't think the other states are going to do this the same way. But this is how we're doing it in Texas. Let's say we pull another file and there's a rent issue there. And this one, you've designated them at 70%, but you're charging them rent over the 70% limit, but it's under the 80% limit. That's your max. You can't go over 80%. So we're going to say this isn't a 70% unit, this is an 80% unit. And again, we're going to fix the designation in our tool, and we're going to look at it and we'll say, oh, no problem. The average still is under 60. We don't have anything to tell the IRS about. However, we've already told you that since you designated them at 70%, you do need to charge them. They get the 70% rent limit. So this would be a state issue that we would cite non-compliance and say, you need to reduce and refund that rent that you've overcharged. So here's another example that we have. This one is a multiple building project. So they answered yes on line 8B, and they did their attachment, and they grouped these two buildings together to make it a multiple building project. And so here we have their target that they're shooting for is all of their units are tax credit units, 100% applicable fraction. And the set-asides that they've used come right out to 60%. And we pull a file, and what happens is that we pull unit 18, and they were designated as a 60% household. And this time, the math mistake that somebody made does make a difference. These people aren't at 60, they're at 70. So if we plug that into our calculation for the project's average, we see that this project average is at 61%. So this, again, there is something for us to tell the IRS here, and that we're going to tell the IRS that there's an ineligible household living in that building. And we don't have a new 8823, so this is how we're going to do it until and unless the IRS says to do it differently. We're going to report household income above the limit upon initial occupancy. One thing I forgot to mention is that if you lease a unit to someone that's over 80%, or if you charge rent that's above 80%, that's just the same as if you're a 40-60 deal and you lease the unit to someone that's over 60%. All the guidance is already there about how to correct that. So you can either reoccupy the unit with a new qualified household, or you can try and do a new certification on them to see if their income has dropped. So if you're charging rent over 80%, you need to reduce it. This scenario here, we see a lot of possibilities for how this could be corrected. So we're going to tell you, hey, your project average is above 60%, and you need to take actions to make the average go under 60. So, and that's going to be up to you to, we're not encouraging you to displace people to fix this, because remember, we looked at that unit status report, and if you could just pull someone off your waiting list that's been waiting for a lower rent unit, assuming they're in this project, that you just need to get someone down like a tier to get the average to come back to 60%, and we would say, now this issue is corrected. So again, lots more responsibility on your part for figuring out how can I correct this issue if you're using the average income set aside. Okay, do we have any questions, Wendy?
Yes, Patricia, we do have a couple of questions.
Okay.
Thank you. The first question is a recert question and designation. Here it goes. At recert, if you choose to leave them, meaning a household, at 30% and their income at recert is now 40%, as long as we keep the rent restricted at 30%, then in this scenario, do we mark the designation on the income cert as 30% or 40%?
30. So if you are choosing to not change households' designations as their income changes, then forever you're going to mark them what they were when they moved in, unless one of the events happens that requires you to change their designation.
Okay. Next question has to do with averaging income. When you are averaging for the project, is TDHCA saying the whole property is the project, or the project is what's designated as individual projects, or what is elected on Form 8609?
Great question. So, and we're going to do a detailed example of this towards the end of the training. But when we're going to monitor for the minimum set aside and the project average, it is project as defined on line 8B of the 8609. So that unit status report that we looked at, that property has 5 buildings, and they've made multiple building election to have all of the buildings be one project. If they had each building be its own project, we would have to test it 5 times. If they grouped buildings 1 and 2 together, we'd have to group those units together to test what's the project's average. Does that answer the question?
Yes, that's perfect. I do have one or two more questions. Here's the next one. So the household that is 60%, and I think they're referring back to your example of the USR, the testing tool. Mm-hmm. But TDHCA says they're 20%. Is TDHCA using 20% to figure out the actual project average?
Yes, and that's why if you look at our summary tab, we're using the 20% as the household's designation to get the project's average is 50.5%. And the owner they designated them as 60%, and that's how come they think the project average is 54%. So we're going to look at what could the household be designated at when we're determining the project's average. And if you think this sounds complicated, I agree. And I don't see another way, because as long as none of the units are over the 80% income or rent limits, if your project average is actually under 60%, I don't see why you're not entitled to claim the credit. And so this looks like a lot that the state needs to jump through to figure this out. But when we file an 8823 with the IRS, we sign it under penalty of perjury that we think you're not eligible to claim the credit. And if your project average is really under 60%, we don't think you have an issue. So we're going to go through this. Again, you're playing the average income game in Texas, and I don't think the other states are going to take this same approach. And again, we are doing this based on the accuracy of your report. So if we start pulling files and we see this report is junk, the people that they have in here in Unit 101, they moved out months ago and there's a new household in there. If we can't rely on the data that you're providing us for monitoring purposes, we're just going to say we don't know if your project average is under 60 or not, because we don't have information from you. Are there other questions?
Yes, I have one other question. It says, what happens if in a 9% application, you said 2 units will be at 20%. However, your property has 1, 2, and 3 bedroom units. What happens? And I believe what they're asking here is if you, about unit distribution.
Mm-hmm. So, our rules are not that prescriptive. And again, remember that at your app, you said you were going to have some 20% units, and year 8, you might realize I can't service debt with these 20% units. I can't offer 20s. So you have to get rid of some of your 80s and pull up to 30s or something like that, which isn't really answering the question. So if you have 1, 2, and 3 bedrooms and you only have 20%, we want to see that the 3 bedrooms, you have a waiting list for 3 bedrooms at 20%, and that's at some point you've had a 20% unit leased in a 3-bedroom unit, that you're being reasonable and making efforts, and that you're not intentionally only offering the 20% units in your 1 bedrooms. That's at this time, that is kind of the best answer I can come up with. And if we have a lot of problems that owners are not genuinely offering the units in all of the set-asides, then we will have to get more prescriptive, and I hope that we don't have to do that. Wendy or Amy, you want to add anything to that?
No, that's great. Thank you. I think you answered the question wonderful.
Are there any other questions?
That's all our questions for now.
Okay. All right. So now we're going to do a poll. Okay. So what's most important is that you understand your roles and responsibilities. Pick what you're offering, designate people correctly, come out to less than 60, have a waiting list, all of that. And how we're going to do it, I can see might be a little bit more confusing. So we have a couple more examples, or we could move on. So we're going to have a poll question to see, do people want to talk more about how is TDHCA going to monitor this, or do we want to move on? So Renee, if you could launch that poll.
Okie doke. Would you like to do it for 1 minute, Patricia?
Sure.
Okay. Okay, so it's been about a minute. 75% have voted, and 67% they are ready to move on.
Good. Me too, because what we're moving on to now is a 5-minute break. So let's take a 5-minute break. Is there like a timer or something you could put on that, like we do at the board meeting?
Can just put up Amy, you could probably pull up a Google timer and share your screen. I'm trying to figure out how to end this poll because now.
All right. Well, mute myself and hide my camera, and I'll be back in 5 minutes to continue discussion.
So 3:23. I can't stop this poll.
And everyone just saw I have shorts on. Okay, so we are back, and before we move on to discuss transfers, we're just going to hammer this home one more time. So TDHCA, if you're selecting average income, we believe you have federal noncompliance. We know you have federal noncompliance if any of the incomes or the rents exceed 80%, and we'll file the 8823 for that. And if your mistakes make the project average to go over 60%, then we will report that to the IRS. However, we see that there can be mistakes that actually don't have a consequence, because even though the income was miscalculated, it's still under 80, the project average is still below 60, so we don't think that that's an issue. You're going to have state non-compliance if you're charging rent in excess of what you've designated that household. So that's the thing for the 2015 4060 set aside. So be really careful about filling out that income certification and making sure that it's done correctly. So next we're going to talk about transfers. And transfers are pretty much the same for all of the minimum set-asides, with a little bit of a nuance for average income deals. So it comes down to how you answer line 8B on your 8609. So households can transfer within a project. If it's two separate projects by line 8B on your 8609, then they can't transfer, they need to do a new certification. So here, first we have an example where it's a multiple building project. So we have the two buildings, they're considered one project, and our question is, can the people in unit 502 transfer into unit 105? And the answer is yes, they can, because it's a multiple building election, and so those two units just swap status and everything stays the same. So let's look at one where it's not a multiple building project. Each building is its own project. And then what happens? So let's note that in the building on the left-hand side of the screen, the project's average is 55%. And the project on the right-hand side of the screen, its project average comes to 52.5%. And the question is, can the people in unit 604 transfer to 202? And we know the answer is no, they can't, because each building is its own project. So they maybe could move over to unit 202, but they can't just transfer over there. If we're going to move them over to unit 202, we need to do a new certification. So maybe they're moving because somebody else moved in, and when they used to be a 50% household, but now at this time they're actually a 70% household. So note what happens to our project average if you allow the people that used to live in Unit 604 to move over into Unit 202. You got to do that certification, and their new income, it pushes the project average to 62.5%. And we've already gone over this before the break about how we'll report that as household income above the limit upon initial occupancy because the project's average is now over 60%. Next, we're going to talk about the available unit rule. And I just want to briefly kind of go over the concept of the available unit rule. So under the Housing Tax Credit Program, as long as when you move in your low-income household, you can experience increases in your income without there being like a penalty. Like if you think about a lot of other programs that help low-income people, like food stamps or Section 8, if you have an increase in your income, you go and you report that, and what happens is your benefit is reduced, right? So you have to tell the housing authority, if you're on Section 8, you tell the housing authority that you had an increase in your income, well then you got to pay more rent. So the tax credit program is not like that. And there's no penalty to the household for improving their circumstances, and there's no penalty to the owner either. No one's done anything wrong. You have to follow the available unit rule. And in the tax code, there's like a threshold where we consider the household to be over income, and that's what triggers compliance with the available unit rule. And it is based on the minimum set aside that's elected by the owner. So this is pretty different than the 20/50 and 40/60 set aside. So for 20/50 deals, you're over income if your income exceeds 140% of 50%. For 40/60 deals, you're over income if your income exceeds 140% of 60%. One thing that I want to make sure everyone is clear about is that for all of the minimum set-asides, you're only required to do recertifications if you have market rate units in your project. So if your project does not have any market rate units, you don't need to do these recertifications and make this determination at all. It's just if you have market rate units in your project. So if you're doing average income, the 140% threshold is different. If you're a household that's designated at 20% through 60%, the threshold is 140% of 60. If you're designated at 70%, the threshold is 140% of 70%. And if you're an 80% household, it's 140% of the 80% limit. So it's different than the other minimum set-asides. So you're going to do your recertification if you have market rate units on your project. And you're going to figure out what's the household annual income now. And if the answer is that their annual income is now less than 140% of whatever the threshold is, then you're just going to follow your policies and procedures. And so your policy and procedure might say, we don't change anyone's designation even if they've experienced an increase in their income. So those people that you moved in 5 years ago that were below 30%, and you know now they are making a lot more money, but it's still less than 140% of 60%, you can choose. You don't have to change their designation because their income has changed. You could, but you don't have to. And if you want to, you've got to have written policies and procedures about that. If you do the recertification and you realize, yes, this household does exceed 140% of the applicable threshold, the unit's now considered over income, and you have to follow the available unit rule. As long as you follow the available unit rule, you can still claim the credit, the household doesn't need to be displaced, everything's fine. The available unit rule is a building rule. It's not a project rule, it's by building. And it requires that if someone goes over income, that you lease the next unit of same or smaller size to a low-income household to replace them. So you're going to keep leasing the units to low-income households until you reach your applicable fraction without considering the over-income people. And while you're doing that, and you may have a situation where no one moves, someone goes over income, but no one moves. And so until the over income person is replaced, you have to keep their rent restricted. And you're going to keep their rent restricted at what they were designated at before. So we're going to look at some examples. Here we have a project that has market rate unit, which is why we have to do recertifications. So we recertify the people in unit 105, and their income is $88,860. So if we look, we see the two-person income limit at 80% is $62,480 times 140%. Indeed, these people they are over income. So this is one of the times we're going to change their designation to over income. And note that our market rate unit is vacant. So until we lease that unit 110 to a new household to replace our people that went over income, we have to keep the rent restricted for the people in unit 105 at 80%. And we're going to lease unit 110 to any household that just maintains our project average below 60%. So it wasn't 80%, but in this situation, this example here, it's just an example, we decided to lease it to a 70% household. And now that I have replaced the over income household, I can change the designation of unit 105 to market rate. I should have mentioned at the beginning, in all of our examples, we assume the units are the same size, just to keep it a little bit simpler. But remember, it's the same size or smaller. So if you had someone go over income in a 1-bedroom unit and you have a 3-bedroom unit that becomes available, it's not a violation of the available unit rule to lease that 3-bedroom to a market rate household. If you have a 3-bedroom that goes over income and you lease a 1-bedroom to a market rate household, that is a violation because that's smaller than the unit that's over income. Okay, let's look at another example. So unit 101, they're a 3-person household and they were designated at 40%. We recertify them and their income is $75,000. So we need to figure out if they're over income. Since they're a 40% unit, we look at the 60% income limit. And we multiply that by 140% to determine if this household is over income, and indeed they are. So 140% of the 60% limit is $73,000. And so these people, they're now over income. And to comply with the available unit rule, I have to keep their rent restricted at 40%. So when I'm determining the project's average for unit 101, I plugged 40% into my calculation there of determining the project's average because I keep their rent restricted at 40%. So unit 102 is a market rate household and they're happy living there and they're not going anywhere. And this could go on for years and it's fine. You just keep recertifying that household when it's time for them to be recertified and you keep their rent restricted at 40% and it's all good. But let's see, I think in our example, someone's going to move out, right? Okay, so let's say what happens if unit 105 vacates. So if unit 105 vacates, to comply with the available unit rule, we have to lease it to a low-income household that maintains our designation. So if unit 105 moves out, we're going to reoccupy that unit with a 50% household, and that's just going to maintain our designation, and that's how we comply with the available unit rule. Now we're going to take a look at violating the available unit rule and average income, and it gets a little messy pretty fast. So let's say that you go on vacation and they hire a temp, and the temp says, you know, I'm gonna do a good job, and the people in unit 105, they move out, and I'm gonna get that unit leased, and they lease unit 105 to a market rate household. So what happens is that's a violation of the available unit rule. So unit 101 is not considered a tax credit unit anymore because we violated the available unit rule. So that's not a 40% anymore. Now that's a market rate household. Our applicable fraction drops to 50%. And we're in that murky water from the beginning of the training about we're not even sure the minimum set aside is met in this scenario because you don't have 3 units that are averaging below 60%. You've got 3 tax credit units, but they average out to 70%. So by leasing that, by violating the available unit rule, you blow your project average, you're in jeopardy of not meeting the minimum set aside, and you have your applicable fraction is only 50%. So remember, it's a once a year test. So, you know, assuming that you're not in the first, you know, the first year of the credit period, let's say it's year 3 of the credit period, we're going to hurry up and fix this before the end of the calendar year so we can get this fixed. So we've got to fix this. So, and getting ready for this training, we, as staff, looked at some interesting things and said, okay, well, what if they occupied Unit 101 with a 60% household? You know, what that does is it really doesn't solve your problem because now your project average is only 67%. It's still above what you need. So if you're in this situation, you may not have been planning to offer any 30% units, but you're going to have to because you've got to get your applicable fraction back to that 83%. You've got to get your project average under 60. So we see to get back into compliance, we needed to lease Unit 102 to a 30% household. And that's how we're going to restore compliance in this building. Another question that has come up is if you have 2 over-income households in a building and someone, a market rate unit becomes available, which designation needs to be replaced first? And so we have the 70% people, they went over income in June, and the 60% people went over income in July. And I feel like every time I do a webinar, my landscapers show up. Can you guys hear the landscaping going on in my front yard? I'm so sorry. Okay, anyway, yeah, there's landscapers right outside my window. But anyway, so the question is, which should be replaced first? And today's September 2nd, and the answer is either one, because the IRS and Treasury Department have not said you got to replace the designation that went over income first, or you got to replace the lower one. And we haven't felt it necessary to put anything in the Texas Administrative Code that would be like a state rule about how you do this. So as of today, the answer is just make sure that you lease that market rate vacancy to a low-income household, because if you move back into market rate, you'll lose the status on both of those over-income units. So just be mindful about that. Okay, and this is another point where we're going to stop and see, are there any questions that have come in in the questions box, Wendy, about transfers or available unit rule?
We don't have any questions right now. I'm checking right now on transfers or the available unit rule. We're good.
All right. So next we're going to talk about additional rent and occupancy restrictions for average income deals. You know something? I looked through the 9% awards for 2019 and 2020. And I mean, I just kind of glanced quickly, but I think only 4 of them are 9% deals. I think the rest of them are 4% bond deals that don't do the competitive scoring. So, but if you're a 9% deal and selected average income, you may have agreed to a lower project average to get additional points. So you could have gotten 16 points for an average, a development average of 55% or lower, 14 points for 56% or lower, or in 12 points for 57% or lower. And that will be reflected at the end of the land use restriction agreement, where all the extra stuff is, like the hub and the nonprofit and all that stuff, it will be in that part of the LURA where your additional rent and occupancy restrictions will be. So let's look at an example of this. Here we have this development that has 5 buildings, and there's a total of 30 units. And we're going to look at how we're going to monitor this for federal requirements versus state requirements. So let's say that this property, for whatever reason, they decided to group buildings 1 and 5 together into a multiple building project. And the other 3 buildings, they decided to make them their own project. So for federal income tax purposes, when we're monitoring, this is actually a 4-project development. So even though there's 5 buildings, when we're monitoring for federal requirements, it's 4 projects. So on the 8609s, we're looking for to see, I think another slide forward and forward again. Yeah, okay. All right, so as far as the 8609s go, we're gonna make sure that those projects are below 60. And because you're LURA, you got those extra points, we're gonna check to see if over the whole development, the development averages to 55% or less. So let's take a closer look at those buildings and see what happens. When we look at the project average for buildings 1 and 5, we group it together and average those 12 out. It comes to 60%, so check, they're fine. Building 3, which is its own project, has an average of 58%, so it's fine. We're at building 3, and they've got an average of 60%, so they're fine. And building number 4, it averages out to 56%, so they're fine. So federally, we don't have any non-compliance here. However, when you take the averages of the whole development of all 60 units, it averages out to 59%. And you promised that for additional points in the QAP, you promised an average of 55% or less. So this is state non-compliance. And again, it's going to be up to you to figure out, how do I get my development average to be under 55%? And we think that you can probably do it by pulling people off the waiting list for the lower rent units, because if you lower their rent, it will lower their designation, and that will get your project average, your development average, down to where it needs to be. Next, we are going to talk about the designation of households that for like an existing property, if you're doing an acquisition rehab using the average income minimum set aside. And we're going to look at properties that don't have a previous allocation and compare it to properties that do have a previous allocation. So where we kind of expect to see, or it seems like a good idea to do average income, is if you're doing a RAD conversion. So if you're doing a RAD conversion, the residents living on your property have a right to return to their unit after it's been rehabilitated. And so in this scenario, let's say the people in unit 103, their income is above 60%. So if you select the 40/60 set aside, you can't claim credit on unit 103 because they're not below 60%, and you can't ask them to move because of the RAD program. So a thought is to instead select average income. So if we see now, if we select average income instead, as long as those people in unit 103, as long as their income is below below 80%, they're going to be considered a tax credit unit, and their unit's going to be eligible for credit. So, given the exact same circumstances, if you select average income instead of 40/60, all of the units are eligible for the program. So that's how That's one thing to think about. If you're doing any kind of an acquisition rehab and you want to do average income, it might help you retain some of the people that are living there. Obviously, anyone that's over 80% is still not going to be eligible if their initial income certification is over 80%, but just keep that in mind. If you do have a previous allocation and that original land use restriction agreement had additional rent and occupancy requirements, we'll see this is just an example of one that's on your slide there. And let's say that your original land use restriction agreement required that you have 11 units that have an income and a rent below 50%, but that was an additional rent and occupancy thing. So originally this was a 40-60 deal. So its 8609s would look like the original ones would have shown that they, back in 2002, when their original allocation, they selected 4860, and now they're doing a rehab and they're getting a new allocation and they're going to mark average income. So the 8823 audit guide provides us with the IRS's thoughts on existing households in the case of a resyndication. And they say that any household determined to be income qualified at the time of move-in for purposes of the extended use agreement is a qualified low-income household for any subsequent allocation of IRC Section 42 credit. And in Texas, again, this is a Texas thing that's on September 2nd of 2020, we are going to extend that to the additional rent and occupancy units from your initial allocation. So let's say that you have a previous allocation here and it did require some 50% units, and unit 102 was occupied by 50% households in 2014, and unit 104 was occupied by 50% households in 2020, and you've got that 60% household from 2012. So do they need to be certified as eligible for your new syndication? No, they don't. So they're grandfathered because of that guidance from the Internal Revenue Service. You do need to check their student status, but they don't need to be certified again. And another example. So we have a property here that has market rate units in the project, which means we have to do recertifications. So look at that unit 102. When they moved in 2014, they were 50. And the most recent recertification I did on them, they were less than 140% of 60%. And the unit 103 people that we recertified, they were at 60%. So for these households, when you're determining what's their designation for average income, we're allowing you to count unit 102 as a 50% household. We're letting them be grandfathered with their original designation. And 103 maintains its 60% designation as well. Okay, were there any questions about that or any of that stuff, Wendy?
Not about that, no.
Okay. All right. So we talked about what things are different or like a little bit nuanced, like when you're transferring with average income, but most of it's the same, right? So if you pick 40/60 or you pick average income, the recertification requirements are the same. If you've got market rate units in your project, you got to do research. If you don't, you don't. All of the UPCS stuff's the same. Eligible basis and what can you charge for, what can you not charge for. The student rule, it's exactly the same. Utility allowances, most of the program is exactly the same. We have thought of a couple of weird things that we wanted to share with you. One is that we've realized we need to update our Section 8 verification form. So, you know, in 1.42-5 in the Treasury regulations, it does permit owners to get a statement from the Housing Authority for voucher holders to document that they're eligible. And we're going to update our verification form to ask what was the date the household was last certified, how many household members were there, and what was their actual gross annual income. And we need that information from, think about that rent testing tool that we're doing, that we need to know not just that their income was less than $30,000, we need to know what was their actual annual income the last time they were certified. So that's one random thought. And here's another really random thought. So in the event of a presidentially declared disaster, the provisions of Revenue Procedure 2014-59 come into play. And they allow housing tax credit units to be leased to households that don't income qualify. So if you're displaced by a presidentially declared disaster, you can use a housing tax credit unit to provide them housing. And the unit has to be rent restricted in accordance with the minimum set aside. So that's pretty easy if you're a 40, 60, or a 2050 deal. You know, if you want to lease to displaced households, doesn't matter what their income is, and you know what rent you're allowed to charge them because it's limited by the minimum set aside. So we just want to point out that this is a little different for average income, but so there will be another presidentially declared disaster. Unfortunately, they happen. And if you're one of these average income deals, just remember this training that we told you, make sure that the rent that you're charging the displaced people, the rent you're charging them makes your project average be less than 60%. So just some takeaways before we are done. We're looking forward to the IRS and Treasury Department in providing guidance. And I don't know why, but I've realized that you don't get to comment on revenue notices, procedures, or rulings. So I hope that when the IRS or Treasury Department release guidance, it's in a Treasury regulation, because for whatever reason, you get to comment on those. So I hope that they release their guidance in the form of a Treasury regulation, and we can all read it and say, no, we don't think that's right, or this doesn't make sense, or what about that? But we look forward to getting some guidance from that. I hope that we've hammered home today that it's really important that you follow your policies and procedures for changing designations. And we spent some time today talking about when TDHCA will be issuing 8823s, and we actually don't think there's going to be many of them, because we think your project average is actually going to be pretty low, because so many of your units are probably going to be leased to Section 8 households. So we're only going to issue 8823s if your tenant incomes or rents are over 80%, or if your project average is above 60%. And I mean, obviously, if you don't meet the minimum set aside and students and all that stuff, but I think we're going to kind of approach this pretty differently than the other states, but we'll see what they do. Yeah, monitoring and interpretations varies very much from state to state, so make sure you get with other states. One thing that we recommend, it looks like if you're doing average income, it's a good idea to make a multiple building election, because if you make a mistake, the mistake is it doesn't carry as much weight if it's averaged in with more units, right? If you have fourplexes and each fourplex is its own project, and you make a mistake, it carries a lot more weight than if you grouped all those fourplexes together into one big project. Then a mistake you make over there in building one is offset by a bunch of other units. So it's probably a good idea to make a multiple building election. And the last thing we want to let you know is that you can do it and we can help. And we are here to help you comply with this program and the average income set aside. So just remember, this is how we're doing it. And we do recognize that the examples that we use for training purposes are kind of oversimplified. It's really easy to see, oh, that doesn't meet the project average when you're only looking at 10 units. But we we can help you through more complicated scenarios. Okay. And that's all I've got. At the very end, it has the contact information for me and for Wendy. So you can email us if you have questions that you don't want to ask right now, but we do have time for questions if there are questions. Do we have questions, Wendy?
Yes, we have questions. So here's the first one. You may want to back up to slide 52.
Okay.
On page 52 example, the market that became available is a bigger floor plan, I guess a bigger unit size, than one of those OI units, which leaves us with just one OI unit to apply the rule at the time.
Oh, let me see. Yep, actually, yes. So this is not a question. This is a correction to our presentation. And this commenter is correct. So, and Amy, I swear we looked at this, didn't we? Correct. So unit 28 is a 1-bedroom unit. So if unit 25 becomes available and you leased it back to a market rate household, you would only lose the low income status of unit 26. So if you violated the available unit rule, you'd only lose the over income status of one of the units. Yep.
Great. Okay, second question. You mentioned if the average income under 60%, you're okay. However, if you got points in a 9% app for being under 54%, you have to be under 54%, right?
Yeah. And that was the slides that we went through where, so federally, you don't have to be below 54%. Federally, your projects as defined by line 8B have to be below 60%. And if you got points in the QAP for being below 50% and you're not, that's state non-compliance. Does that answer that question?
I believe so, yes. Next question. Back to presidentially declared disaster. If this exists, what are the rules for the other set-asides?
So that question actually pertains to all of the minimum set-asides. So let's say you're a 40-60 deal and you're supposed to have 10 units at 30% of area median income, and you're leasing units to displaced households. If for some reason you're not able to, if you've got so many displaced households that you're leasing to, that you don't have 10 units below 30% of area median income, you would be out of compliance with your additional rent and occupancy restrictions unless you took advantage of what's in 10.626 of the Texas Administrative Code, and that's where you ask the executive director for a temporary suspension of a part of the rules, because that's a state requirement, not a federal requirement. And so it might be possible. So for any of the set-asides, if you don't meet them, that we would say you're out of compliance with the additional rent and occupancy restrictions unless you get a waiver of that requirement.
Great, thank you. Next question is about minimum set-aside. Is it 20 at 50, 40 at 60 of the total number of the units in the project, or is it the low income units in the project?
When you're calculating the minimum set aside, you look at the total number of units in the project. Remember, we looked at that, that underwriting report for something and they had 200 units. So it doesn't matter that there's some of them are designated as market rate. You look at the total number of units in the project. And if you're a 20/50 deal, at least 20% of them have to be below 50%. If you're a 40/60 deal, at least 40% of them have to be below 60. And if your average income, at least 40% of them have to average under 60. So in other words, you can have a really low applicable fraction, but your applicable fraction can't be less than the minimum set aside. Well, you could on a building if you group it with another project. You can't have a project that has a target applicable fraction less than the minimum set aside, is the technically correct answer.
Great,
Anyone
thank
add
you.
to that? Staff or Amy, Wendy, did I explain that okay?
Yes, that's
Okay.
perfect. We have just a few more questions. Next one, if the project does not have any market rate units, meaning they're 100% low income, and the household that moves in is low income, meaning they're income eligible, and now they have more income later, more income, then the project would not be out of compliance since recerts are not required. Just want to confirm this.
Correct. So you're not required to do income recertifications for 100% low income projects. If you don't have any market rate units, you don't have to do a recertification. And if it comes to your attention that they have more income, you're not obligated to do anything about that. If you want to adjust people's designations and rent as their income increases, you'd have to have a written policy and procedure about that. And that other webinar that we did goes into a lot of discussion about that.
Great. Next question. Does this just apply to housing tax credits but not to bonds? Average income.
Oh, the average income set aside is definitely just available for housing tax credits. So if you have an allocation of tax exempt bonds and an allocation of housing tax credits, you got to meet both programs' requirements. So if you get a tax exempt bond, you have to have the minimum set aside met. And most of our tax exempt bond properties elect the 40/60 set aside. So they have to have 40% of the units below 60. And they can do average income for the tax credit allocation. Does that answer the question? You want to unmute that person and see if they want to follow up with something else?
Do we want to, it's Anna Everett, if we want to unmute her?
Or maybe she doesn't want to be unmuted. Does she answer her question?
Yes, she responded yes this time.
Okay, good. Okay.
Sorry, these questions are not in order, so just give me 1 second. I know we have at least one more.
Sure.
And I'm finding Anna to unmute her.
I think she said her question was answered.
Oh, she
Yes,
did.
she
Okay.
did.
Okay.
This is a general question, Patricia. How does TDHCA approach non-compliance different from other states? I don't know if we,
I have no idea.
I don't know if we have an answer for that.
Yeah, I don't really know. I have no idea. I think you'd have to ask people that are operating in more than one state. I hear things, but I don't really know.
I believe that, one more question. If we're using the underwriting report to designate the units, it will help us be in compliance? Question
Yes.
mark.
Yeah, so that, and I mean, I think that if you're tasked with leasing up an average income deal, that you got to start with the underwriting report. That's definitely where you should start. There's a lot of, in these uncertain times, I mean, how many times have we heard that said? So if your deal was approved, in 2019, there maybe it was 80% rents were achievable at that time. And now that COVID has hit and there's been some changes in the economy, you may find I'm not able to get 80% rents. And so, this example where they were shooting for 9 at 30, 58 at 50, and 17 at 80%, you may find, you know, I can't get those 80% rents. I might be able to get 70% rents, but I can't get 80% rents. So you might decide to do 70s and instead of 30s, do 40s. You just got to average out to 60%. And management companies will have, you know, appropriate oversight of this. I think that, you know, it's a pretty big swing here when you're changing these things around. And so obviously if you're the leasing agent or whatever, although it's fine with us, if you change these designations around, check with your boss and make sure it's okay with your boss that you're changing all of these things around before you move forward and decide we're going to do 70s and 40s instead of 30s and 80s, right? That it's not an issue with us, but just make sure that you don't get in trouble with your boss.
Great. I have one more question. Can you have home units, meaning home funds, mixed in with your average income units or deal?
Yes, yes, you can. And we do have deals that are layered in with average income and multifamily direct loans. So those multifamily direct loans, those land use restriction agreements are highly prescriptive, where it says you need to have this many at 30, this many at 50, and this many at 80. So sticking to that and layering in the average income is how you're going to have to do that, because you're going to have to meet the set-asides for the multifamily direct loan programs. And then you might have a little wiggle room to play around with some other set-asides under average income, but you're going to have to meet the multifamily direct loan set-asides. So you might as well, you know, use those as your designated units. You might as well offer the same designations that your multifamily direct loan LURA requires. And the other thing that to keep in mind is that the income limits might be slightly different. So I mentioned that revenue ruling 2020-4, where the IRS gave guidance about how to calculate the 20 through 80% limits for the tax credit program. And HUD's 30% limit in particular may be different than the 30% limit for the housing tax credit program. So run your income and rent total twice as well if you're doing that.
Great advice. I have another question. For income average, wait lists need to be maintained for each set aside. Can you briefly discuss how the wait list should be maintained for tax credit units with current set asides? Does one wait list need to be maintained? I want to ensure I understand.
Okay. So what we require is that you have a written policy and procedure about your wait lists, and that your wait lists are available for all the different designations. Now, if you have multifamily direct loan funds, then in HUD's guidance, there is something about chronological order, that you have to do it in chronological order, that's who comes off the waiting list. And if you don't have multifamily direct loan funds, then your waiting list could be something different. I gave some examples where I said, you're going to pull someone off the waiting list to solve non-compliance because you've got your project average above 60%, and you need to pull somebody to get the average under 60%. So when you're doing average income, and it's like that underwriting report that we looked at that has the 30% through the 80%, so that's going to be a lot to have all of those waiting lists, and they have to be available all the different unit sizes. So again, not highly prescriptive, just that you've got to have a waiting list and you need to have written policies and procedures. And you know, your waiting list policy can say we don't allow more than 10 people on each of the waiting lists for the different designations and unit set asides. If we don't think we're going to be able to offer you a unit in less than 12 months, we're not putting you on the waiting list, right? So design those policies and procedures in a way that work for you, and watch that other webinar that has more information about the waiting list stuff, because there's some things that you cannot change or apply retroactively in your tenant selection criteria and your written policies and procedures, but this isn't one of those things. So if you figure out my waiting list policy is a disaster and this is too complicated, then you can change that policy. And it's Kate Trace is over that area about the waiting list policies. Did that answer that question?
Yes.
Amy or Wendy, you want to add anything?
No. Another question, how would exempt units be treated out of the average income deal?
That is a great question. I mean, it's exactly the same. So under a 20/50, 40/60, or an average income deal, if you have a building that's 100% low income and your management, maintenance, or security people live in one of the units, the unit comes out of the numerator and the denominator of the applicable fraction. If you're doing an average income or one of the other set-asides and you have market rate units in that building, because remember, this is an applicable fraction issue, and you want to move a management, maintenance, or security in, they need to move into a market rate unit in order for you to maintain your applicable fraction. Wendy, you agree, right? Yeah.
I totally agree.
Yeah, it's just the same. So if it's 100% low income building, they move in, it doesn't affect the applicable fraction. If it's a building with market rate units, you need to put them in a market rate unit. You need to designate their unit as one of your market rate ones.
Patricia, would you also remove them from the average? They don't have an average. That exempt unit does not have an average.
That's right, their market. Yeah. Oh, and right, if they're in the 100% building, they don't have an average. Right. So let's say there's 10 units. Let's say it's a one building project, right? And in our oversimplified scenarios, then you're going to be taking the average of nine households and making sure it's below 60%. Good point, Amy. Any other questions? These are good questions.
Yeah, we had lots of good questions. There's a few questions that I have sent a private message to for more information, and we don't have enough information to answer that question, but we will follow up privately on those questions. And there's just very few of those.
All right.
And we are good.
Yes, so we're going to make this webinar presentation available, and on our website we will also have the handouts, this presentation, and that Excel spreadsheet so that you guys can play around with that. And it's not perfect, it's a work in progress, and it's a starting point for us to get our arms and minds around how we're going to monitor average income deals. So again, I want to thank everyone so much for joining us, and Amy for putting these slides together, and Wendy for answering all the questions, and that's it. Hope everyone's staying safe.